All right, welcome back. Let's get right into it, because today we are tackling one of the biggest, most misunderstood ideas in trading. We're going to move past just looking at win rates and uncover what actually leads to long-term success.
You know what I'm talking about, right? You're scrolling, and you see these flashy posts. Someone's winning trade after trade after trade. And man, they look convincing. They make a strategy seem like it's totally foolproof. But they don't tell you the whole story. And what they're leaving out can be seriously costly.
So that brings us to this wild question. It sounds completely backward, doesn't it? But the answer is a huge, unequivocal yes. You absolutely can. So how is that even possible? Well, that's exactly what we're here to break down.
Okay, so let's start by looking at this obsession people have with their winning percentage. I call it the win rate trap. It's such an easy number to focus on, but trust me, it can be incredibly misleading.
Here's the fundamental problem. Your win rate only tells you how often you win. That's it. It says absolutely nothing about how much you win when you're right, or, way more importantly, how much you lose when you're wrong. You can have a whole string of small, frequent wins that feel amazing, but they can get completely wiped off the map by one single catastrophic loss.
So, if win rate isn't the whole picture, then what is? Well, to really, and I mean really understand how a strategy performs, you need to be looking at three key numbers altogether. And here they are. First, yeah, your win rate still matters, of course. But second, you need your average win size. So how much do you typically make on your winning trades? And third, your average loss size. How much are you losing on your losing trades? When you only focus on that first one, you're basically flying blind. You're missing the entire story of your strategy. Now, these three numbers don't just exist in a vacuum. They all come together in one super powerful formula. And this, my friends, is the hero of our story today, the expectancy equation. This is the metric that really tells you if you can survive and profit in the long run.
So what the heck is expectancy? Put simply, it's what you can expect to make or lose on average for every single trade you take, assuming you run your strategy over and over again. It tells you point blank if each trade is actually making you money or slowly costing you money over time.
And here is the math behind it. And don't worry, it looks simple because it really is. You just take your win rate and multiply it by your average win. Then you subtract your loss rate times your average loss. Oh, and your loss rate? That's just 100% minus your win rate. Easy.
What comes out of this equation tells you everything. If your expectancy is positive, congratulations, you have a real mathematical edge. It doesn't mean every trade will be a winner, but over the long haul, the odds are stacked in your favor. But if it's negative, well, your strategy is structurally leaking. It's like having a slow, steady hole in the bottom of a boat. Yeah, it might stay afloat for a little while, but eventually, it's going down.
All right, theory is great, but let's make this totally concrete. Seeing a real example is where the light bulb really goes on. So let's look at a tale of two very, very different traders.
So, in one corner, we've got Profile A. I like to call this trader the fragile winner. They win a lot, but they're kind of walking on thin ice. And in the other corner, we have Profile B, the resilient earner, who might not win as often, but has a system that's built to last.
Okay, let's really dig into this table. Look at Profile A, an incredible 85% win rate. But their average win is just $1, while their average loss is a massive $10. Maybe they let their losers run, just hoping they'll turn around. The math doesn't lie. Their expectancy is negative 0.65. That means for every single trade they take, they're losing 65 cents on average. Now, look at Profile B, a much lower 40% win rate, but their average win is 4 times their average loss. They cut their losses quickly and they let their winners run. Their expectancy, a beautiful positive 1.0. For every trade they take, they are earning, on average, a full dollar.
And this chart just lays it all out, doesn't it? That amazing win rate for Profile A is a total illusion. It's a siren song leading straight to a negative result. Meanwhile, Profile B, who loses more often than they win, has a clear, profitable mathematical edge. This right here is why expectancy is the only metric that truly counts.
So, the million-dollar question is, how do you actually apply this to your own trading? Well, here is a super practical checklist you can use right now to figure out if your strategy is structurally sound or if it's structurally leaking.
First up, you have to track every single trade. And I mean every one. No cherry picking, no deleting the bad ones.
Then, just do the simple math to find your average win and your average loss. After that, it's the moment of truth. Plug those numbers into the expectancy formula. Face the music. If it's negative, don't argue with it. Instead, look for the dangerous pattern. Does one loss wipe out 5 or 10 or even 20 of your wins? If it does, you've found the leak. The fix always starts with controlling your risk and knowing exactly when you're wrong.
So look, if you take only one thing away from all of this today, let it be this. A high win rate makes for a great headline on social media, but your expectancy, that's your actual financial reality.
And that really leaves us with the next big question, doesn't it? Figuring out your expectancy is step one. It's like getting the diagnosis. But once you know what your edge is, the real work begins. How do you protect that edge? How do you nurture it and make it even stronger over time? Well, we'll dive into that in our next session on journaling and review.
And hey, before we wrap up, just the important reminder. This is all for educational purposes. It is not financial advice. Trading digital assets involves a very real risk of loss, so please always do your own research. Thanks for tuning in.